Hi, everybody, and welcome to Bridgewise Live webinar. Today's subject is Investment Intelligence 2.0, Strategic Approaches for Data-Driven Success. I'm Ilan Furman. I'm acting as Bridgewise CIO, which I can testify is a pioneer of adopting AI and machine learning for financial analysis and improved financial decision-making. Throughout my career in the traditional asset management, I've witnessed firsthand a lot of development and changes in the framework, in the very traditional framework of financial analysis. And today I'm very excited to discuss this topic with two leading financial research executive and in general, which we will address this topic. And maybe the best would be to pass it to David Lenchus and Dato Neto to present yourselves, please.
Dato, you want to go ahead? Okay.
No,
hi, everyone. I'm David Lenchus. I'm Managing Director and Director of Research at H.C. Wainwright. I oversee about 50 analysts, supervisory analysts, associates, and administrative personnel within the research department. Prior to HC, I was managing director and director of research at a healthcare-focused investment bank called Chardon. And prior to Chardon, I was at a full-service brokerage called BTIG, where I was most recently managing director and director of research, and started my career way back at Pali Capital, where I was in research operations. Turn it over to you, Dato.
I definitely should have gone first. There's an amazing track record, David and Ela. It's a great pleasure to be around and to be here with you to discuss this. Actually, I'm a founding partner and fund manager at a proprietary fund called Tuesday Capital, in which we invest in equities. We do public equities, private equities, VCs, and early stage developments, either here in Brazil, Latam, and offshore as well. Prior to that, I was a former managing director of Banco Modal in Brazil, where we led the initiative of IPO in the bank. So we listed the bank. Then I had the pleasure of conducting the transaction in which we sold the bank to XP Inc., which is a Brazilian financial services brokerage firm listed in NASDAQ. And prior to that, I founded 11 Financial Research, which happily became the most relevant independent research firm in Brazil. We were the first independent research firm in Brazil ever to be inserted in the global consensus of all Bloomberg terminals globally. So, which is really relevant due to the high level of scrutiny that they did from a technical perspective. And prior to that, additional 15 to 20 years in the M&A industry, most of the time in the US, doing M&A and private equity in private and public sectors.
Great, thank you very much. I think I'll just start with the Q&A because exactly it will be very interesting to hear your views on this ever-evolving topic. So the first question will be, basically, in your eyes and in your personal experience, how have you seen this role of the very traditional framework? I mean, with the intelligent investor being written in the 40s, etc. How have you seen the role of the research department evolved, with particularly referring to this data-driven and data processing that we've seen in recent years?
I can get that first. Honestly, it is doing research. It is basically about deep diving. I was always obsessed with how deep could we dive into either equity, bond, and macroeconomic analysis. It is all about how deep you can go. Because I think people mix a lot when you present some research, opinion and report or recommendation or whatever with some kind of fortune telling. It's not about knowing the future. It's how deep you can go and how you can crush that, everything that you know. If you take like, and I'm a really admire of the behavioral economics school. So if we can quote like Daniel Kahneman in one of his most famous acronyms, which is VISIATI, which is what you see is all that is. So you deal with what you can reach and what you can structure. And from an analytical standpoint, when we became more able to dig deeper, being data-driven, being helped by structure, by models, by a huge amount of information, and we started being helped on crunching that, on processing that, because it's not about raw data. It's about how you deal with it, how you process it, how fast and how deep can you go. So it changed dramatically the industry. The capability of delivering fundamental analysis, structural analysis, after all the package that we can have from a data collection, data processing, more than that standpoint, I think it changes all the landscape. If you talk to fund managers, to institutional investors, to individual investors globally, we are all overwhelmed with information all the time nowadays. So there's a difference between overwhelming people and analysts with information and data-driven the structure and the mindset of it. So it's how we deal with it and how we do process that. So Ilan, what I've seen is that all the capabilities that were really boosted by data-driven tools, by how we can reach and how we can, getting back to the Kahneman stuff, see more things. More things, understand more things, reach further and deeper rationales and hypotheses, test hypotheses, understand whatever kind of externalities can come up to the table, and then come up with some really solid view. And at the end of the day, it's an opinion. But the more you can base that on solid information and well processed information, I think this industry has been changed and now it's definitely being disrupted for good.
Yeah, Dato, that's exactly right. And just to inform, I don't know exactly the type of audience that's watching right now, but just to inform what Dato just said, I'd be remiss without starting with a couple numbers since we're having a conversation about research. But think about this. The year 2024, this year, we have about 251 business days to work, right? So that's about 366 days because it's a leap year, less 52 weekends. And I'm talking about less US public holidays. So it gets us to about 251 work days. Now, actually, if you take a vacation, a 2-week vacation, you get 10 more days. So let's use 241 days. We have 241 days to do work. Now, what Dato was just talking about going deep into research, imagine this. Typically on Wall Street, an analyst will cover 20, 30, 40. I've seen analysts cover 50 or more stocks. For every stock that you cover, there are 4 earnings cycles. For each earnings cycle, you need to write 2 notes. One note, which is previewing the earnings, what you think is going to happen on the call to let the investors know, give them a heads up before the call. And then you also have to do another note, which is a takeaway note, right? It's what actually was spoken about on the call and what you think the impacts are. And you want to let the investors know how to look going forward. So for each stock you cover, there's 8 notes right there. So if you cover 30 stocks, that's 240 notes right off the bat on 241 days. Now, that doesn't account for daily news flow. Daily news flow could be a clinical readout. It could be a product launch. It could be a CEO left the company. It could be the Fed changed rates. It could be a major hack across all institutions. So daily news flow may also impact all the stocks you cover. And so you're actually writing on that as well. And these aren't just fluff pieces. You've really got to go deep. In addition to that, you're working on multiple initiations of stocks, right? An initiation of a stock is when you haven't covered the stock yet. You need to do a total deep dive, go underneath the hood of this company and really put out a report which puts out your verdict and your recommendation. And by the way, this has nothing to do with going to conferences and writing takeaways, by hosting conferences and writing takeaways, by hosting key opinion leader calls and doing takeaways, by doing thematic pieces across the department on deep dives about the industry, or even doing collaborative weekly pieces. So it's a sell-side equity research is a labor-intensive, high bandwidth task. And in order to do that, as Dato was just saying, you have to use these tools. The change that we're seeing now is that these tools are helping us be smarter, faster, and more efficient. Because imagine trying to pack all of that writing and to the depth that Dato was talking about over 241 days. And by the way, writing research is not the only thing that research analysts do. So it's a lot, and adopting these tools helps us be smarter, faster, and more efficient. And at the end of the day, what that is productivity, right? And so I'm sure we'll talk a lot more about
that. Just a quick comment, Elon.
Yeah.
Just let me know, David, if you find an equity analyst that can work only 241 days a year.
Exactly right. Exactly right.
Okay.
So thanks a lot. Yeah, I mean, definitely we'll touch more on productivity, which we all need that booster, let's put it that way. But that is one thing that is definitely happening. My second question is also, very curious to hear both of your opinions as heading research and global. So how have the changing market condition impacted your approach to gathering and analyzing data? And I'm referring to the fact that we all became more global consumers and global investors. So I'm very curious about that, please.
Sure.
David, please.
Yeah, sure. I mean, look, more market data equals more market dynamics, I should say, equals more market data, right? So, imagine you're an analyst that is looking at a US-based coffee company, and now this coffee company is deciding to expand its footprint and go into China. That is a huge lift as an analyst that now you need to understand. You now need to understand the regional market dynamics. You need to understand customer behavior and customer tastes. A coffee shop in Shanghai is going to have a different menu and likely different product offering than one in Louisville, Kentucky. You need to understand the local laws and regulations that may become a barrier to operations and supply. You need to understand global factors, political factors. So trying to do that lift of going from a US-based coffee shop, a coffee company, to now looking at all of these dynamics in China, you can't go to the library. You can't even go to Google because it's just too much. So what we're doing, and I think what most firms are doing, is investing in tools that are going to, pardon me, do exactly what Dato and I were just talking about, make you smarter, faster, and more efficient by those tools going out and gathering the data and summarizing the data and analyzing the data and providing you with all of that information so you can get up to speed a lot quicker.
Thanks.
Yeah, David, it is, to tell you a little quick story. When we founded 11 and the company started to grow, at some point we had 30, almost 40 analysts, combining equity analysts, macro analysts, and credit analysts. And I had now I have just a great friend, but at that time I had a head of research that he was pushing me because I did not let go the equity coverage of metals and mining, because I just love that. I just love that. So I held that to myself because it was pretty much connected to macroeconomic environment. And where am I getting there? Because we have, if I'm covering like a giant mining company in Brazil, which is Vale, one of the global players alongside Anglo American and all the giants, we have to look and we have to understand deeply equity, credit, and economic data from China, from Australia, from the greatest economies in the world. Like if the U.S. is pushing hard infrastructure, that will definitely impact directly the iron ore prices. So how do we price that? How do we combine? How do we understand that cyclically? So it is about the need and the demand of understanding more at a faster pace all the time. So when you look at, and I always added high value to the credit side of it, because it is my opinion that most of the time, the secondary credit market anticipates some events that the equity market will reflect after that. So if we have a look at the quality of the credit of the companies globally, and from a sector standpoint, you can preview some stress that can help, that can happen in different sectors, in different markets. So think about how do we put everything like this together in a mixer and transform that into an analysis that is reachable for investors and that is understandable for investors, and that can make we accomplish our own fiduciary duty as analysts, that is to deliver the best possible outcome on the research itself. So it is definitely, guys, about, from my perspective, not denying the inevitability of how things have changed in the world. And I would like to give back to both of you guys with a question, with a comment and a question. People who work with me, and I'm not saying that I take away all the empirical side, all the experience that we have by doing this our entire lives. People who work with me used to say that I used to make valuations on a paper napkin, which is basically my point always was, if you can't explain what you're doing in a paper napkin, you're definitely not doing it right, like from a rational standpoint. But think about the following: how fast our business environment changing globally now? How fast companies are gaining market and are being picked out of markets nowadays? If we bring back to the fundamental discussion on basic valuation modeling, how can we perpetuate anything now without looking at the fast-paced changing environment in the world? Like, exactly. I hate perpetuity, but I always hate it. But nowadays, it is absolutely unbelievable how you need to foresee and to be able to understand who are the big winners on each cycle and who will be out of the market in the next cycle.
Yep.
And information and data-driven decisions and data-driven analysis are pretty much empowering ourselves. So it's not about all those dark machines, matrix world that say, okay, they're going to invade Zion and we're all lost. That's definitely not going to happen. We're empowering ourselves. We're using technology as a huge enabler just to fit us into a global environment of a fully integrated financial services and financial investments globally. A guy in Japan investing through Mizuho Bank, through Rakuten, whatever, these guys can press a button and invest in a security in US, in Brazil, in Africa. So capital flow also changed the dynamic, and decision making needs to be empowered by that. So it's not about fighting human against machines. It's about understanding how globally everything has changed and how we can be empowered by that.
Yeah, exactly.
I say, and it's probably coupled with a lot of wishful thinking, but I claim that we will not be replaced by AI, but we will be replaced by a human using AI better than us.
Yeah, that's right.
Because you have to exactly that. You have to be able to process this data. So, but obviously I'm a human, so I may be a bit not objective.
Right. AI may give a different answer.
Yeah, yeah, yeah.
So my next as a investment and research people, we can't live with risk and compliance and without risk and compliance. So I want to combine these questions. At the end of the day, how do you balance this need for these fast data-driven data decisions and publications with the need to remain very compliant in an increasingly regulated environment?
Uh, if I can start now, David, and I promise
Yeah.
to be faster than I was on my last answer. I truly understand that when we have regulators that are looking properly into the marketplace, it is helpful to set boundaries and to separate those who are doing the job properly, because it is about people's investments. It's not a beautiful story, but it is about people's life savings. It is about all the wealth that is generated through the world. So you need to be responsible on that. If you look at research industry, like if you get back to 2014, when we first launched in Europe, I think it was the first adoption of the MiFID II regulatory act, in which, for those who do not know that, it is basically a regulation that set separation between research areas and investment banking areas in banks in order to avoid or to mitigate the extension of conflict of interest. And honestly, based on that trend, I built my own independent research company looking into those markets, because I do understand it was a nice move at that time. But honestly, you have to understand that if there's a conflict of interest, and there's a lot of it in the industry by the nature of the industry, when you set proper boundaries, when you set regulations that and you are in compliance with them, and you play by the rules, and you understand the rules, and then you follow strictly, because these regulations, even more from this now fast changing environment which we are discussing here, it is about the quality and the integrity mostly of the data that you're working with. Openly in the internet, we have a whole bunch of crap. If we take that into consideration in our decision-making process, it is definitely a problem. So it is about understanding that we have a safe environment from which we collect the data that we'll crunch, process, and bring that to the outcome analysis.
Yeah, okay. That's right. And just to hop on that idea of conflict of interests and MiFID too. So the conflict of interest also really separated, and I think this is what you were alluding to about starting the independent research firm, is that it really was related to making sure that compliance was monitoring that banking had no influence on research, right? So that research remains independent of their own thoughts, independent of their own coverage, of their ratings, of their price target, even compensation. And MiFID just enhanced the transparency of how conflict of interests were carried out, and also of how research got paid from the investors. And at the time, the advisors had to really take the money out of their own P&L in order to pay for the research. But compliance is very, very important. The conflicts of interests, keeping barriers, information barriers between research and banking, so that it mitigates transfer of material non-public information, making sure that just regulatory, straight up blocking and tackling of regulatory rules of disclosure, so that in each research report, it will tell you how the analyst got to their valuation, how the analyst what risks the analyst believes are maybe leading toward actually getting to the price target and rating, and also any disclosures when you're at a bank. If there was any banking activity, the investor needs to know about those types of things. So it's extremely important for compliance to play this type of role so that research can remain independent and that their fiduciary responsibility is to the investor.
Very interesting. Thank you. I just add one point that is interesting when working with the systems like Bridgewise, for example, then this is exactly right. Like this dialogue with compliance, and you're already embedding the rules in the system. So again, with this AI, you are reducing a little bit the human error probability. So that's like another very interesting thing that you can work with it rather than against it. So that's very interesting. So thank you. Maybe just a bit of almost like a personal investor question with this, again, this fast data driven and this increased capacity to process data. Do you feel it impacted your horizon as an investor? Meaning the data is so fast, but you still want to make a longer term decision, or did it impact your horizon as an investor?
Well, I think it does both, right? I mean, what happens is that the real-time data allows you to see the price fluctuations in the price, right? Some event can happen which is going to affect two things: the near term and the long term. Trying to think of an example. It could be, again, let's look at a pharmaceutical company that may be awaiting an FDA approval on a new drug, right? So during that period, you're going to get these price fluctuations in real time as there's development and as the market's reacting. If the FDA grants approval of this drug, two things are going to happen. One is there's going to be a near-term market reaction, and you as an analyst can quickly take a look at this, update your recommendation, and let investors know, here's the near-term market reaction that I'm expecting, and here's how you can position yourself in the near term. But at the same time, this data is important for me to evaluate long-term positioning for you. Because I can talk to you about the near-term trade, and I can also talk to you about the long-term, the drugs market potential, or the competitive landscape, or the revenue forecasts, how it's going to be impacted in the long term. So I think data allows you to think in two ways. Now, as an analyst, I just have to fully disclose that you need to stay within your thesis. You can't say, hey, this is a buy, but sell now. But you can say, look, the market's overreacting, the stock has dropped. My thesis is it's a buy. This is a great opportunity maybe for you to actually add to your position. But I think all that data and real-time data allows you to see both playing fields. Do you agree, Dato?
I definitely agree. I'm pretty skeptical about the applying the long-term view, like the old-fashioned value investing story and stuff. As I was telling before, like I always hated perpetuity, even more now. So it is absolutely tough to find out companies that you can actually forecast to holding a security for 10 years, 15 years, 20 years, or something like that. We definitely don't know. And understanding that we don't know, I always respected way more what I don't know than what I do know, which is way little, right? I do know little things, and I do not know many, many things. So I do respect that big shark that is out there. So considering what I cannot do, data helps me a lot on understanding on different industry. Where should I limit my horizon? And that is so important, because if you think about, let us use two examples, like NVIDIA and Vale, the mining company. The possibility of disrupting and changing dramatically Vale's environment is way lower than NVIDIA business environment, that because of the amount of research and development, about the amount of fast changing structures and business and industry and stuff. So when we collect data from a time horizon standpoint, data-driven analysis can help us modulate exactly how do I balance my horizon, my reasonable horizon? Where do I see where's the point in which forecasting ahead of that increases my mistaken risk, my risk of making a big mistake in here. So it is also about understanding that I cannot and I should not use, and I always told my teams and my analysts to do that. You cannot analyze, use a freaking spreadsheet, sorry for the wording, spreadsheet model for any equity in any sector. And that is, when talking about, as Elon was talking about Bridgewise, when using AI, when using all this data-driven stuff, you can add these differences between the model that will crunch the information, and that you can add some macroeconomic stuff and cycles that will impact more some securities than other. How do you modulate on that? So I think, from my perspective, what helps me a lot on the data-driven, on the capability of reaching more data, it is about how do I set my investment horizon, and it changed it for me dramatically. Now I set different investment time horizons based on the facts and the data that I can see now and that I can understand. So the expectation, the return expectation, can be modulated on that. And David, isn't investing all about managing expectations, buddy?
Yeah, and being wrong a lot of the time.
A lot of the time.
Great, thanks a lot. I have another question for you from a bit of a different area, given that you headed this big organization and research teams. So the research team always create these insights. So my question is basically, have you seen this distribution of the internal department to the other departments change? Because that is always this challenge, right? So this is kind of if you can share your thoughts here, that would be great.
Yeah, I could do that pretty quickly. I mean, it used to be distributed via fax. Right? I mean, research used to come onto your desk in hard copy, just tomes. Obviously, email was adopted and widely adopted, and PDFs were adopted. So at least the delivery has changed. There are still a lot of rules and regulations around social media and public appearances, but I think we have been able to adopt these types of delivery methods. Obviously, we're doing a webinar right now on podcasts. You could make public appearances on CNBC or on the news channels. You can deliver in many different methods. You can even, across the street, you see banks that are tweeting that at least get you back to the research portal where you can see the disclosures. And the same thing on LinkedIn, where they'll post something and say there's been an initiation, and click here and check it out, and it gets you back into the environment that's regulated. So yeah, I think that delivery has changed. Although I would also say no, because Dato was referencing MiFID before, and it was interesting. I think something happened, if I remember this survey. At the height of MiFID, sell-side research was actually just crushed. So I think that the number was like about 2% of all sell-side research was actually red. Now, those numbers have gotten better. But I mean, think about that. Yes, we're keeping up to date on delivery method. But even with better numbers than 2%, are we actually getting to the investor who needs to read the research? And by the way, it's not always about content. It's funny, I was reading a book about Einstein. And even when he first published equals MC squared, nobody read it, right? Mm-hmm. It wasn't about the content. So yes, we're using all the methods to get out there, but I still think that getting to the right investor with the right content at the right time so that that content is read is still a question that may be and likely will be answered by technology, right? Really targeting the investor.
I could give no answer now, and I will be more than satisfied with what David just brought up, because I definitely agree with everything, and it's tough to add something on that. But what I would say is that the delivery method and technology is now disrupting one thing from a research standpoint. Research is now, like the word with open finance and technology and all these things. What happens at the end of the day is that financial services and investment as an industry has definitely changed. Mm. Like, where do I put my money on? Which bank, which brokerage firm do I use? Is, at the end of the day, if we analyze deeply, pretty commoditized. So it's all about the service. And people are overwhelmed with information, as we had discussed before, and people are out of time, and we are working, all of us in every industry, many hours, and we have demands from family, from kids, from whatever we want to do. People are, yes, more willing to spend some time on taking care of the health. There's all this quality of life things, but that takes time. So if you put everything into consideration, what do you expect as an investor, individual investor, not those who make as a professional role, as the three of us do, but as individual investors? Financial services industry, from my perspective, is globally being transformed by the way internal advisors like bankers or independent financial advisors can deliver the service of taking care of their clients. Mm-hmm. And it is absolutely what is transforming the industry. If you look at the Net Promoter Score, which is roughly a way of analyzing how satisfied clients are with its bank or brokerage firm and stuff, I could bet that there's a high correlation between higher NPS and higher profit, because you engage your investor more, you serve them better. So research and technology are ways of delivering more and more to investors, making them invest better, making better decisions. So it is not about how do we deliver now the research to the end investor, but how do we enable the industry to better serve our clients, the end investor. And we use that as a big channel it's like a safety net. You create a layer on it in which you deliver to bankers and to financial advisors, and competition has helped a lot because you raise the bar on higher competition, you raise the bar on services. So when you do that, at the end of the day, you're saying to these guys, you are the safety net, and the investors need to be safe by being guarded by you. And we are, from a research and technology point, the enablers of installing those safety nets and keeping it safe, really. So I think from a distribution perspective, this is the great change that I'm seeing globally.
It's important to be always careful. In a previous company, we did emails and we said, let's check the distribution rate. And we saw 99%. And then I talked with someone there. He told me, yeah, it's their firewall that automatically opens.
Correct. Yeah. Or yeah, it's all the security that's looking at, or another way I like to say it is it's the investors who have 1,000 emails in their inbox and they hit that box at the top and they just delete all of it. All of them are open. It's the actual engagement with the note when they click through that you can see, and that number's much lower.
Yeah.
We have time for one more question, and then we're going to go for Q&A. So I'm very curious because all the time people are saying the industry needs to remain competitive, etc. So the question is, what are the key trends or the key solutions that this traditional finance industry needs to adopt in order to remain competitive in the next decade?
I'm sorry, let me just start because I didn't know this question is going to pop up, and I've just answered this question on my last answer because
Right.
it is basically how the industry is treating investors and how everything is connected and how it is not, again, I hear a lot of stuff when people is saying that about AI, about technology, how these things are all or evil or needs to be flawless or whatever, and it has absolutely nothing to do with it. But to understand, guys, if we can use this, and we hold ultra power computers in our hands, in our pockets now, why do we deny the inevitability of impacting technology inside this investment decision-making, investment support, and how the industry relate with each other globally? It is absolutely unmatched. The capability of scaling solid way of investing in decision-making process using technology as a big enabler. So it is what it is. It's undeniable. It's inevitable. My father, now he uses Spotify. He does a lot of things on his cell phone, but he keeps answering "What's up?" with that sign. You know, but at the end of the day, from a generational perspective, he can do that now, and he can have a slow decision-making process. The new generations and those who are building wealth, who are making their investments and who are looking ahead, are more inserted into that. So it's transformational and it's irreversible. It is about understanding the inevitability of it and taking the best out of it. Sorry.
Yeah, and that's 100% right. And you know what? I would just add one thing, which is, you know, when you talk about this, you're really talking about the democratization of information now across anyone who's got an internet connection in any language, right? I mean, what I wonder is how that impacts or empowers what we call the retail investor, right? You've got the institutional investors who have typically been the largest share of trading volume and trading participants on the street. But now you're seeing, particularly since COVID, you're seeing this rise in retail investors. And in fact, I was listening to something the other day, and I heard a statistic that said that post-COVID, retail investors now make up anywhere between a third and 40% of the overall market share. With this democratization of information to anyone, anywhere, in any language, what's that going to look like now over the next 5-10 years? How is that going to empower the retail investor? And are the retail investors going to increase and become more of the market? And if that's the case, then there's this sort of edge that gets this information edge that gets lowered, and perhaps you get even more market efficiency.
Interesting. Great. Wow. Thank you. I think we can go for a few questions from the audience, if that's okay with you.
Sure.
So please write the question in the chat. I have one here that it's a question and asking for advice. So it goes, if everybody is using AI tools, how can the individual analyst fund manager can create alpha or differentiation?
It is a very good question. But what investors need to understand is that it is about understanding analysis as a tool for decision making, which is discretionary, which it varies from investor to investor. which varies from the risk profile that you're willing to do, your investment horizon, or everything. It is not, absolutely not about making the world having the same information, the same recommendation, and following the same at the same time. This is absolutely never going to happen. It's not what it's all about. It is about utilizing it as an enabler, as I've been saying, as a powerful tool for decision making. Like, I can take some risks on the equity side. I like doing bonds a lot, and there's a lot of volatility in bonds as well, which people think the volatility is only on the equity side, but we do have, even more in the US, with the huge liquidity that there's on bonds. But I can take risks. Like if I see a company that I do understand that is going through a bad moment, and the question involved professional fund managers and stuff. So I'm looking at a company to their numbers are going down, but I can have all this data-driven information that will allow me to understand what is happening. And then there's a decision-making process that varies from investor to investor, from vehicle to vehicle. One is high risk, high yield. The other is only investing in investment grade from a bond perspective. The other is more focused on super ultra large caps. The other does small and medium caps equity. So it changes the strategy a lot. And the decision-making, buddy, the decision-making is all about individually taking decisions. So there's one mistake in the origin from my perspective. The investors, if you look at the perspective that AI will decide for you, you're taking away your responsibility of making your decision on your investment, taking care of your family. And I'm sorry to tell you, you won't have that chance because you have, and you are, and we all are, responsible for the decision making we do at whatever area in our life it is. So there's nothing like commoditizing decision making, and even more capital allocation.
Totally agree. Totally agree. You know, and the way you find alpha, I know this sounds a little bit easy, but it's very interesting. The way you find alpha is to think creatively, is to find adjacencies, and technology can help you do that. Let me give you a strange example on this. 80% of all music songs written are love songs. Okay. Yeah. So how do you create alpha? If you want to write a song, have you ever heard a song where, you know, you knew where it was going and you really liked it, and all of a sudden there was this really great change that you weren't expecting, it yet it fit? That's alpha, right? That's a different way of thinking, of doing the same thing that everyone else is doing. So using this technology now to scrub LinkedIn, to look to do a head-to-head comparison of two companies, and to look at the quality of their hires over the past 2 years and who has the better quality hire. It's sort of intrinsic adjacencies. It's about asking the right questions and looking for those right nuggets, or creating this sort of other musical moment in the way you think. And it's very, I think, more than ever now, because technology has been gathering the data, has been summarizing the data, analyzing the data, it's actually changed the narrative. And now, as analysts, you can go and spend more time focusing on the thesis and asking the right questions than on gathering the data. So if you're focusing on asking the right questions, you can think in adjacencies. And I think that's really where you're going to find alpha. Creative thinking.
Great, David. Thanks a lot. I have a question here who is targeted for Dato about the Brazilian market from a very dear friend who is a big adopter of innovation in the Brazilian market, Pedro Meduna. So his question is, he wants to know from Dato, who has the experience of building 11 research, what is your view on the opportunity of Bridgewise as an intelligence and research provider in a market like Brazil?
Pedro, really glad that you're here. And I'll promise not to call you to say all these things again on the phone, so you're already listening. But it is a pleasure to have you here. Pedro is a great VC fund manager. I think the opportunity is unique, and I'm not exaggerating. As I was talking before, the capability, like what Brazilian investors are facing, is the need to deepen its financial education and the opportunity that we never had in Brazil of investing globally, which mitigates structural risk and stuff. I don't think, and I don't see globally, but I don't see in Brazil. I'm answering about Brazil. This being a end use, a retail tool to scale the basis of the pyramid from the investors. Well, but what I do think is that technology like Breedwise can change forever the way bankers, financial advisors, and all financial institutions in Brazil can take care of their clients based on the speed, based on the capability of foreseeing opportunities in the market, bringing to their clients, bringing to investors more rationale about decision making, other than limiting their support to them to their own research structures, which are we have a kind of dysfunctional financial market in Brazil from a banking perspective. It's so concentrated that people are becoming and are having, and even our stock exchange has been investing a lot on bringing people and putting brokerage firms and putting banks to show people this opportunity to understand how to save and to invest in that. But it passes through decision-making process through financial education, and having a platform delivered through the financial institutions that has, as I was saying in the other answer, that safety net and that fiduciary duty to take good care and to educate investors. What I think is that in countries which there's a lot of money and there's a lot of opportunity, but there's still a gap of financial education, what Breedwise can do from a technology standpoint is absolutely transformational.
Thanks, Dato. David, do you have anything to add on that, maybe from experience you've seen in other markets?
I could just answer it from the seat that I'm in, which is, it goes back to everything that we've been saying right now. It's, being able to use a tool like Bridgewise will enable analysts, especially through the chat feature. It simply changes the narrative. It allows the analysts to spend more time on doing what they really need to do, which is their thesis, asking the questions. We haven't really even talked about the non-technology aspect of what being an investor and an analyst is, which is actually having time for this, to have human-to-human conversations and share IP in this matter. That's a big part of what makes an analyst come back to their seat and do their analysis. It's talking with the investors, it's talking with the community, it's talking with key opinion leaders. So if they're just looking at the numbers, if they're just doing the book value, if they're just doing the spreadsheet like Dato was talking about before, they're not getting the big picture. The fact that now you can use technology or Bridgewise to actually do that heavy lifting for you, it makes you materially more productive in the areas that really matter now.
I just got a WhatsApp message from the actual CEO of 11 now, from Rafi. He just sent me a note and it popped up on my screen. He wrote down, "This is research 3.0, which is basically it.
Very good.
It pretty much defines what we're talking about.
It's good, and thank you so much. It was a great discussion, and thank you, David and Dato, for sharing all your insights. It's been very interesting, and to be honest, with the rapidness that we're seeing, the things changing, I think we will need another webinar like that in 3 or 4 months. So thank you very much to everybody participated. We covered a lot of topics, so if you want to continue the discussion with us or know on the case studies of how BridgeWise empowers organization in implementing these new tools, please reach out. We are here. And thank you very much.
Thank you. Thanks for having
Th-
us. This was a great conversation.
Thank you.
Thank you, guys. It was amazing. And I did not chat anything, David.
Thank you. Ciao.
Thank you,
Bye.
guys. Bye.